Let me just point out to you as we think about the global economies going up. Let me just go through this real quick. So we've got European stocks are sliding as the dollar is getting higher. So right now the dollar going, their dollar going higher, the euro going higher against the U.S. dollar is not a good thing for their markets because that reflects the exports. Now, it's likely that they're going to stay positive because they opened in positive territory, like everything else is going to open in positive territory in reference to the Fed-fueled rally, which is looking like what we're going to have today. Coal giant Peabody says that it's very likely that they are, or warns that they could declare bankruptcy at any moment. Caterpillar warns that they're not going to have such a good quarter and warns for the future. This is, again, both these things, two indictments on what is going on globally in the market. Swiss Bank holds negative interest rates. They're not looking to get out of negative interest rates. This thriving economy that some people think we have, and that's why the markets are going up, is not so thriving globally. Again, not even Swiss banks. They're going to hold. Norway cuts their rates. Norway, a very strong economy, very good currency, large sovereign wealth fund. Norway is cutting their rates from 0.75% to 0.5%. They are running out of ammunition quick as well. Euro trade surplus shrinks primarily due to slower growth in China. Japan exports down for the 5th month in a row. New Zealand growth is steady, but not quite steady enough because they are cutting their rates in all likelihood. American income continues to shrink through most workers in the American economy. When we look at inflation and the PPI numbers, purchasing power and all those kinds of things, and when we analyze the numbers of what has happened, the largest movement in consumer price index yesterday was in the retail sector, and it was up significantly. So clothes are costing a whole lot more right now. I point all these things out. I just gave you a very quick cross-section of the globe. We touched in Asia, Northern Europe. We look around the world and we see everybody concerned and worried about certain things, even in the midst of their markets going up a little bit. Why? Because the Federal Reserve decides not to cut. I bring all this up just to remind all of you that stocks right now, yes, they may continue to rally based on a Fed-fueled rally. The Fed didn't do anything specifically to create a rally other than give a good indication that they're not going to raise rates and maybe not raise rates anytime soon. That's enough. That's enough for this market to rally a little bit. But do you understand that the fundamentals of the economy, either here or globally, are not getting any better? So stop, please, thinking that this is the time to be flying into the market with all your money. Please, pull back on the reins a little bit. Slow down and relax. It's been 4 weeks, not 4 months, not 4 quarters, not 4 years. Weeks. And we're not even near any kind of real recovery in the market.